In this video, we'll reveal our top 5 candlestick patterns, starting with the basics and moving on to more advanced strategies. Additionally, we'll show you how to combine these patterns with price action to spot high-probability trading setups. Consider this your ultimate guide to mastering candlestick trading. If you're enjoying this content and want to see more trading lessons, don't forget to subscribe to the channel and give this video a thumbs up. We'd love to hear from you, so drop a comment below and tell us which topics you'd like us to cover next. Now, grab a cup of coffee, sit back, and let's dive in. What are candlesticks? A candlestick is a style of price chart utilized in technical analysis, showing the high, low, opening, and closing prices of an asset for a specific time frame. For example, on a daily chart, each candle represents one day of trading activity. This charting method was developed centuries ago by Japanese rice merchants and traders to monitor market prices and daily momentum. Over time, it gained widespread popularity and eventually became a staple in U.S. markets. The anatomy of a candlestick. The 4 key elements of a candlestick are the open, close, high, and low prices for a given time frame. The candlestick's shape changes depending on how these prices, the open, high, low, and close, relate to one another. Open price. This is the initial price at which the asset begins trading for a specific day. Close price. The final price at which the asset trades by the end of that day. High price. The peak price reached by the asset during the day. Low price. The lowest point the asset reaches throughout the day. Each of these components provides insight into the asset's price movements within the chosen time frame. The section between the opening and closing prices is known as the body. The color of the body reflects whether the price movement was bullish or bearish. When the closing price is higher than the opening price, the body is typically green, indicating a bullish movement. Conversely, when the closing price is lower than the opening, the body is usually red, indicating a bearish movement. While colors may vary across platforms, green and red are the most common. The length of the candlestick body provides important insight to traders. A longer body represents a stronger price movement. A long red body suggests intense selling pressure, signifying fear, while a long green body indicates strong buying activity, indicating optimism in the market. Upper and lower shadows. Most candlesticks feature thin lines, often called shadows or wicks. The upper shadow is the line that extends from the top of the candlestick body to the highest price reached during the trading period. In contrast, the lower shadow extends from the bottom of the body to the lowest price reached in that period. The length and position of these shadows offer important clues about market dynamics. A relatively long upper shadow suggests that buyers push prices higher, but selling pressure or profit-taking brought the price back down near the session's close. This can indicate potential resistance levels or suggest a shift toward bearish sentiment. Conversely, a short upper shadow implies that buyers maintain control, reflecting strong bullish sentiment. A relatively long lower shadow suggests that sellers initially drove prices lower, but buying pressure pushed the price back up near the session's close. This can indicate potential support levels or hint at a shift toward bullish sentiment. In contrast, a short lower shadow implies that sellers maintain control throughout, indicating a strong bearish sentiment. That covers the anatomy of a candlestick. Knowing how candlesticks are structured and the information they reveal is key to mastering candlestick patterns. Now, with this foundational knowledge, let's move on to explore the most common bullish and bearish candlestick patterns. Basic and simple patterns. We'll start with the simpler patterns first, which consist of just one candle. Number 1, pinbar. The pinbar candlestick pattern is one of the most popular trading patterns, and for good reason. Traders use this pattern to spot potential trend reversals or continuations following a pullback. Its accuracy is especially high when it appears near key support and resistance levels, trend lines, or moving averages. A bullish pin bar is marked by a long lower shadow, a small body, and a relatively short upper shadow. For the pattern to be valid, the tail, lower shadow, of the pin bar should account for at least 2/3 of the total length of the candlestick. This structure indicates strong rejection of lower prices and hints that a bullish reversal might follow. Examples. This chart shows gold to USD. As you can see, there was a downtrend and a bullish pin bar formed. The lower shadow accounts for more than 2/3 of the length of the candle and is green, which emphasizes the weakening of sellers and the beginning of an uptrend. Following this candle, the trend reversed, resulting in the formation of an upward trend. In contrast, a bearish pin bar has a long upper shadow, a small body, and a short lower shadow. This upper shadow shows a rejection of higher prices, signaling potential momentum loss and a possible bearish reversal ahead. Once a bearish pin bar is confirmed, traders often seek short selling opportunities to capitalize on the anticipated downward move. Example. Here, we can also see an uptrend followed by the formation of a bearish pin bar. The upper shadow of the pin bar is significantly long, making up more than 2/3 of the candle's length. Additionally, the candle is red, which further underscores the indication of a trend reversal. Following the formation of this candle, we observe a clear shift in momentum, resulting in a transition to a downtrend. Number 2, doji. The term doji comes from the Japanese word meaning the same thing, referring to candlesticks where the open and close prices are nearly identical. The length of both the upper and lower shadows may change. In a classic doji pattern, the upper and lower shadows are typically of equal length, further emphasizing balance in the market. This pattern reflects indecision, suggesting that neither buyers nor sellers have control, leaving the market in a state of equilibrium. For traders, a doji signals caution. It's often wise to wait for additional confirmation before making strong buying or selling decisions. It's also worth noting that there are other types of doji patterns, each with unique characteristics and meanings, which we'll cover in more detail in future videos. Example. Here, we observe a doji candlestick forming within an uptrend. A doji signifies a moment of indecision in the market during that specific time frame, reflecting temporary uncertainty rather than serving as a definitive signal for a trend reversal. As illustrated, the bullish trend continues following the doji. Therefore, it's crucial to recognize that a single doji pattern is unlikely to reverse an entire trend on its own. It's essential to avoid the mistake of going short solely based on the appearance of a doji in an uptrend, as the prevailing trend is likely to persist in most instances. Number 3, marubozu. The term marubozu translates to bald head or shaved head in Japanese, referring to a candlestick with a long body and no wicks or shadows. This pattern can indicate either bullish or bearish sentiment, depending on the color of the candle. It serves as a valuable tool for traders, as it signifies clear control by either buyers or sellers and suggests potential momentum for trend continuation. A bullish marubozu is represented by a long green candlestick with no upper or lower shadow. This signifies that buyers dominated from the opening price to the close, indicating a robust bullish sentiment in the market. Example. This chart illustrates the USD currency pair. During an uptrend, a bullish marubozu candlestick emerged. The opening price aligns with the day's lowest point, while the closing price matches the day's highest. This pattern indicates strong buyer dominance, suggesting the continuation of the upward trend. As observed, the bullish momentum persisted after the formation of this candlestick. In contrast, a bearish marubozu has a long red body without shadows, showing that the price opened at its high and closed at its low. This formation suggests that sellers had full control, with selling pressure persisting throughout the entire session, indicating strong bearish momentum. Example. This daily chart of the USD CAD pair offers a clear example of a bearish marubozu pattern. When this pattern emerges during a downtrend, it highlights strong selling pressure, signaling that further declines in the asset's price are likely. As evident, the downtrend persisted following the formation of the bearish marubozu candlestick. Now we will move to intermediate patterns that consist of two candles. Number 4. Engulfing. The engulfing pattern is a two-candlestick formation where the body of the second candle fully engulfs the body of the first. This pattern is a powerful reversal signal and can be either bullish or bearish, depending on its context within the prevailing trend. Bullish engulfing pattern. A bullish engulfing pattern is a candlestick formation that signals a potential reversal of a downtrend or the continuation of an uptrend following a retracement or pullback. This pattern consists of two candles. The first candlestick is red, followed by a larger green candlestick. The body of the green candlestick should be significantly larger than that of the red candlestick, with minimal to no overlapping shadows. Additionally, the green candlestick must open lower than the close of the previous candlestick and close higher than the high of that candlestick. This pattern indicates that buyers have gained control, suggesting that the price is likely to rise. Example: this GBP/USD chart provides an excellent example of a bullish engulfing pattern. The prevailing trend is upward, and the pattern forms at the end of a retracement. It begins with a red candlestick, followed by a large green candlestick that completely engulfs the body of the previous one. This pattern signals the end of the pullback and the resumption of the uptrend. As seen in the chart, the bullish trend continued after the formation of this pattern. Bearish engulfing pattern. Conversely, a bearish engulfing pattern occurs when a green candlestick is followed by a larger red candlestick, which completely engulfs the body of the previous green candle. This pattern is the opposite of the bullish engulfing pattern and signals that sellers have taken control of the market. It suggests a potential decline in price, often prompting traders to consider short-selling opportunities. This formation is particularly significant when it appears at the end of an uptrend, as it indicates a possible trend reversal. Example: this chart of the GBP/USD pair shows an uptrend, with a bearish engulfing pattern forming at the peak. The pattern consists of a small green candlestick followed by a larger red candlestick that fully engulfs the previous one. This signals a potential trend reversal, and, as observed, the pair entered a corrective phase after the formation of this pattern. Number 5. Harami pattern. The term harami comes from Japanese, meaning pregnant, and describes the pattern's appearance, which resembles a pregnant woman's body with a smaller candlestick inside it. The harami pattern consists of two consecutive candlesticks. The first candlestick has a long body with small shadows, while the second candlestick is smaller and entirely contained within the body of the first candlestick. This candlestick pattern is considered a trend reversal pattern that can either be bullish or bearish, depending on the color of its candles. Bullish harami pattern. This pattern is a type of candlestick chart pattern used in technical analysis to predict potential reversals in a downtrend. It consists of two candlesticks. The first candle is a large red candle that shows the market was going down. The second candle is a smaller green candle that fits completely within the body of the first candle. The large bearish candle shows strong selling pressure, and the smaller bullish candle suggests that sellers are losing control and buyers are starting to step in. This pattern signals that the downtrend might be coming to an end and a reversal to an uptrend could follow. Traders usually wait for the next candle to confirm the reversal, which should close higher to validate the bullish trend. Traders typically use the next candle, that is, the third candle, to confirm the pattern. This is because the bullish harami pattern on its own only indicates uncertainty about the continuation of the downtrend. However, the third candle, also known as the confirmation candle, shows that buyers have taken control of the market. If the confirmation candle is green and closes above the second candle's closing price, it provides stronger evidence of a trend reversal to the upside. On the other hand, if the third candle is red or closes near the previous levels, it may signal the failure of the pattern and the downtrend could continue. Example: in this chart, we observe a downtrend. At the bottom, a bullish harami pattern forms, consisting of a large red candle followed by a smaller green candle. To confirm the pattern, we look at the third candle. The confirmation candle is green and closes above the previous candle's close, signaling the end of the downtrend. Clearly, this marks the beginning of an upward trend. Bearish harami pattern. This pattern is used to predict potential reversals in an uptrend. Just like the bullish harami, the bearish harami also consists of two candlesticks. The first candle is a large green candle, indicating strong upward momentum in the market. The second candle is a smaller red candle that fits entirely within the body of the first candle. The large bullish candle shows strong buying pressure, while the smaller bearish candle suggests that buyers are losing control and sellers are starting to gain strength. This pattern signals that the uptrend might be coming to an end and a reversal to a downtrend could follow. Traders typically rely on the next candle, that is, the third candle, to confirm the pattern. This is because the bearish harami pattern alone only signals uncertainty about the continuation of the uptrend. However, the third candle, also known as the confirmation candle, shows that sellers have taken control of the market. If the confirmation candle is red and closes below the second candle's closing price, it provides stronger evidence of a trend reversal to the downside. On the other hand, if the third candle is green or closes above the previous candle's close, it may signal the failure of the pattern and the uptrend could continue. Example: in this USD CAD chart, we can see an uptrend. Near the top of the trend, a bearish harami pattern appears, consisting of a large green candle followed by a smaller red candle. To confirm the pattern, we analyze the third candle. The confirmation candle is red and closes below the second candle's close, indicating the end of the uptrend. This clearly marks the start of a downward trend. Advanced patterns consisting of 3 candles. This is a detailed and important topic, which is why we've decided to cover it separately in our next video. Until then, stay tuned and see you in the next one.